Welcome back to Economic Insights. I'm Alex, and joining me as always is Salim, market veteran and producer of this show. Salim, what a week it's been. Markets seem to suddenly remember that don't fight the Fed thing everyone forgot about 2 weeks ago.
Well, Alex, it's amazing what happens when Fed officials start using the magic words. The market went from doom and gloom to euphoria faster than you can say, Kevin Hassett for Fed chair.
Speaking of which, we've got a lot to unpack. Fed rate cut expectations surging, Ukraine peace talks making progress, and the S&P 500 posting its best week in 6 months. Let's dive in. Take us through what drove this massive market rebound. It seemed like everything turned on a dime.
It did, and the catalyst was pretty straightforward. Fed officials basically gave the market permission to price in a December rate cut. Early in the week, the probability jumped from 29% to 77% after Governor Waller and San Francisco Fed President Daly explicitly advocated for a cut at the next meeting. But I think New York Fed President Williams was the one that did it for the markets. By midweek, the rate cut probability was at 82%.
That's a huge swing in just a few days. What was the economic data showing to support this?
Well, here's where it gets interesting. The Dallas Fed Manufacturing Index dropped to a 5-month low unexpectedly. Consumer confidence came in at 88.7, below all expectations and the lowest since April. Even the delayed September data showed retail sales and PPI coming in soft, so you had weak data giving the Fed cover to cut.
But didn't we get strong jobs data late in the week?
We did. Initial jobless claims fell back to 216,000, the lowest since April. But here's the thing, the market had already decided the narrative. Fed's cutting in December, and one strong data point wasn't going to change that story. The probability stayed around 80%.
And equities just took off?
The S&P 500 posted a 3.7% gain, its best week in 6 months. By midweek, it was just 1% from its record high. It's the classic liquidity-driven rally. When the Fed pivots dovish, asset prices respond. Add in the news that Kevin Hassett, who's known to endorse rate cuts, emerged as the frontrunner for Fed chair, and you've got a perfect setup for risk on.
We also saw some interesting geopolitical developments. What stood out to you there?
Ukraine peace talks made real progress. Trump and Zelensky slimmed down the negotiating points from 28 to 19, intentionally leaving out the sensitive territorial questions for direct discussion. A U.S. official even said Ukraine had agreed with the U.S. on terms of a potential deal. Ukraine's 10-year dollar bonds rallied. Yields fell to their lowest since August.
That's significant. And US-China relations?
Trump and Xi held their first talks since the tariff truce. They covered Taiwan, Ukraine, and Chinese soybean purchases. Trump confirmed he'll visit China in April. Xi will visit Washington in 2026. Markets love reduced uncertainty, even if it's temporary.
Let's get into the developed markets in more detail. Start with the US. What are we seeing beyond the surface level optimism?
The October FOMC minutes revealed something pretty remarkable. A deeper analysis shows participants became less aligned on key fronts than they've been in recent memory. There's real division on the future path of monetary policy.
Division? But they just cut rates in October.
Exactly. While most participants agreed further cuts would likely be appropriate to move toward a neutral stance, several said they didn't necessarily view another 25 basis point cut as appropriate in December. Others said policy would still be restrictive even after the October cut. It's messy consensus at best. The real risk is going forward. The consensus approach of rate decisions may be dropped. We may start to see hairline split outcomes, something we haven't seen in 3 decades. I am not sure the global markets are ready for this.
What about inflation? That seems to be stuck.
Core PCE has been in a range of 2.8 to 2.9% since May 2024. We're not making progress. Participants couldn't agree on the magnitude of tariff-related effects on inflation or how persistent higher inflation will be. The challenge is that goods inflation from tariffs is offsetting disinflation in housing services, and upside risks to inflation remain elevated.
So the Fed might cut in December, but then what?
The market's pricing in further cuts for next year. I'm not sure they materialize.
Let's pivot to Europe. The UK budget made headlines this week.
It did, and there was even a chaotic leak before the announcement. But once Chancellor Reeves revealed the details, the market liked what it saw. Fiscal headroom increased more than expected, and 10-year gilt yields fell significantly. Though by late in the week, yields rose again on concerns that the fiscal tightening was too backloaded.
So markets are worried the pain comes later rather than sooner?
Precisely. It's the classic political move. Promise discipline tomorrow, spend today. European equities followed the global risk-on trend, though. The Stoxx Europe 600 had its best day in 2 weeks and posted 4 consecutive gains.
What about Japan? They had some data releases late in the week.
Tokyo's core CPI rose 2.8% year on year in November, and industrial production and retail sales both came in better than expected for October. It's keeping pressure on the Bank of Japan to eventually normalize policy, but they're in no rush.
Let's talk currencies. What moved this week?
The New Zealand dollar was interesting. The Reserve Bank of New Zealand cut rates by 25 basis points as expected, taking the cash rate to 2.25%, but the announcement was perceived as hawkish because they projected no further cuts in 2026. The Kiwi rallied sharply on that.
So markets expected more cuts down the road?
They did, and they didn't get them. Meanwhile, Australian bond yields rose after October's CPI unexpectedly jumped to 3.8%. So you're seeing divergence across the Asia Pacific central banks, some dovish, some more cautious.
What about oil and gold?
Oil prices generally fell midweek as receding inflation fears and peace talk progress reduced risk premiums, though they moved higher late in the week. Bitcoin rebounded above $90,000, but it's still on track for its worst monthly performance since 2022. The crypto volatility continues.
And the AI chip story? That was fascinating.
It was a reminder that even within big tech, there are winners and losers. Google released its Gemini 3 AI model, which restored some confidence in the innovation cycle. But news that Meta was in talks to buy Google's AI chips put pressure on Nvidia, while Alphabet and Meta rallied. It's a rotation within the sector, not a wholesale rejection.
Let's get to emerging markets. Start with Korea. The Bank of Korea surprised people, didn't they?
They held rates at 2.5%, which was expected. What wasn't expected was the hawkish tone. One member even voted for a cut, so it wasn't unanimous. But the guidance shifted from maintain its rate cut stance to leaving room for potential rate cuts. That's central bank speak for we're done for now.
Why the shift?
They revised GDP growth forecasts upward for 2025 and 2026, mainly due to strong semiconductors and the conclusion of Korea-US tariff negotiations. They also raised inflation forecasts, noting that elevated USD to Korean won exchange rates pose upside risks to inflation. So they're seeing better growth, but also inflation concerns. The rates market is now pricing in the end of the easing cycle.
Well, that's a big change in expectations. What about India? They had a big GDP data this week.
India delivered a massive upside surprise. Q2 real GDP growth accelerated to 8.2% year on year, a 6 quarter high, well above the 7.3% consensus. Manufacturing grew 9.1%, services around 9%, with financial services accelerating to 10.2%. Private consumption jumped to 7.9%, and fixed capital formation held at 7.3%.
What does that mean for the outlook?
Full year growth forecasts have been revised up to around 7.2%, but expectations are for the momentum to slow in the second half of the fiscal year, with growth moderating to 6.5 to 6.6% next fiscal year. The key point is that nominal GDP trends matter more for corporate earnings and fiscal ratios, and those are less impressive.
We haven't talked about China yet. What's happening there?
We'll be watching the official PMIs this Sunday and private gauges early next week. The focus is on whether the recent stimulus measures are gaining traction. The US China talks were constructive, as we mentioned, but the real test is whether domestic demand picks up.
And what about Central Europe? I know Poland's been in focus.
Poland's inflation fell to 2.4% year on year in November, below the central bank's target and the lowest in 19 months. That's opening the door for more rate cuts. There are expectations for another 25 basis point cut in December, with a terminal rate of 3.75%. Poland's economy is strong. Industrial and retail data suggest output is on track for nearly 6% annualized expansion. So you've got strong growth, low inflation, and room for easier policy. That's a nice setup.
And Turkey, anything notable?
Rather unusually, CBRT Governor Karahan appeared on a live TV program this week. Karahan indicated a more dovish stance by suggesting policy rate cuts could precede a decline in inflation expectations, while expressing optimism about the inflation outlook. Hence, the market expectations for a cut shifted higher. Upcoming data is expected to support this view, as November's CPI momentum is anticipated to slow due to corrections in fresh fruit, vegetable, and core goods prices. Although domestic demand rebalancing is supporting the fight against inflation, services prices remain persistent. That needs to break.
So what should we be watching next week? There's a lot of data coming.
Big week for US data. The ISM Manufacturing Index comes Monday, ISM Services Wednesday. We also get the delayed September PCE report on Friday. That's the Fed's preferred inflation metric. Forecasts are for core PCE to remain unchanged at 0.23% month on month, keeping the year on year rate at 2.9%.
That's still above the Fed's target.
Exactly. And that's why some analysts think the Fed will stay on hold in early 2026 after the December cut. You've got sustained solid growth and above target inflation. It's not a recipe for aggressive easing.
What about the labor market?
ADP employment report comes Wednesday. That's the most recent labor market data Fed officials will have before the December 10th FOMC meeting. It'll be scrutinized.
And internationally?
Eurozone flash November CPI comes Tuesday, following reports from Germany and France. We'll see if inflation continues to ease there. China releases official PMIs Sunday, private gauges Monday and Wednesday. Japan's got Ministry of Finance data on Sunday and a speech by BOJ Governor Ueda on Monday. There's also an OPEC and non-OPEC ministerial meeting on Sunday.
So plenty to keep us busy. Any final thoughts on what you're watching most closely?
The US data is key. If we see continued labor market strength and sticky inflation, the Fed's going to have a harder time justifying cuts beyond December. Markets are pricing in an easy path to lower rates. I'm not convinced they get it. And keep an eye on China's PMIs. If those disappoint, it could dampen the global risk on sentiment we saw this week.
Excellent. Well, we'll be back next week to see how it all plays out. Thanks as always, Selim.
My pleasure, Alex.
Before we go, don't forget, folks, we do not give investment advice. For that, please consult a professional. Thanks for listening to Economic Insights, and we'll catch you next week.